Thank you, and good morning, everyone. It's great to be here today. I'm Cardno's new CEO. As you know, I started in August, so I've been around about 4 months now, and it's my pleasure to deliver the first half-year performance overview that I've done for Cardno. We're going to go through the slides that we've provided to you, and I'll refer to the pages on each slide as we move through them. Sitting next to me today is Peter Barker, who's our CFO, who will be delivering the presentation with me. So I'm going to kick off on slide 3 and pick up some of the key points in our 2019 half-year performance. I think the first thing to say is that we're in the process of going through a performance improvement process with the business. And obviously, I've been at that since I joined. We're in our 3rd year of that, and our focus is consistent. We're focusing on cost control. We're really focusing on getting our organic growth engines up and running, investing in our people, and continuing to make sensible, strategic, and accretive acquisitions. In terms of our financial performance at the half-year mark, our fee revenue is up. So we're at 414 million for the half. That's up 9.7% on the prior year. And our EBITDA is 27.9 million. That's a little bit down 7.6% on a prior year comparative. I think some of the reasons behind the EBITDA performance is that we're still working on improving the business performance in certain areas, particularly in APAC. We had a soft start with lower levels of utilization than we expected, as we were in a period where we were rolling off some larger projects and waiting to move our staff onto some big projects in the future. So we had some softness in utilization. I'm pleased to report after the first 3 months, particularly in APAC, our business, the second 3 months in the half have really picked up, and I think we're on a solid trend now through to the end of the year. So in terms of our conversion of EBITDA into operating cash flow, and we had a 34.9% conversion. And that, if you're looking at last year's result, was primarily driven by the timing of a very large government payment that we benefited from in the last year comparison, and this year it just fell slightly outside of that. It's been a busy 3 or 4 months for me. We've completed 3 acquisitions in our consulting engineering footprint. In regional Victoria, we bought the TGM business. And we're really excited about that because it builds out our regional Victorian footprint, similar to a footprint that we have in New South Wales and in Queensland. And we've done very well in the regions of the big states. So we're excited about the possibilities that that's going to bring to us in the future. We also bought a small business in the Florida Keys. And then significantly, we expanded our high-performing construction sciences business to the US with the acquisition of Raba Kistner just before Christmas. In terms of balance sheet, things remain strong there. So we secured new debt financing just before Christmas that was partially used on those 2 acquisitions that I just mentioned. And we're very happy with how our balance sheet is at the moment and how we're performing on that. In terms of division by division performance, Americas Engineering continues to improve with revenue up 11%. But also what we're really happy about is we're seeing the margin increase in that business. So we've been really working on that business to improve its efficiency as well as its top-line growth. And the margin has increased just under a point in the last year, and we expect further increases in margin going forward. Asia Pacific Engineering, as I've said, we struggled a bit in the first 3 months with that transition, rolling off some large projects. So our revenues were down a point and a half, and our margin was down from 9% to 6%. It's getting a great deal of focus from us, and more of that later on. But that's a real key priority for me and the leadership team there, to get that business up and running to the levels that we experienced before. And we're confident that we see a way through to that. We're investing in ramping up, in particular, business development, where as we were delivering on some of these large projects, I think we dialed down our business development efforts, and we need to reinvigorate that. So I'll talk a little more about what we're doing there later on. In terms of construction science, I've already indicated very strong performance. Revenue's up 37.8%, definitely benefiting from infrastructure spend in Australia. Due to the mix that we have in client and projects, our revenue's down slightly. It slipped from 12.3 to 10%, but on very strong revenue growth there. ID, our international development business, which primarily serves the governments of the UK, the US, and Australia, revenues are up 8%. And our margins there are down, but we expected our margins to be down because we've been investing heavily in that business, particularly to build up our UK arm of that business around a very strong spending UK government development program. And what I would say about that business is it's actually on or slightly above budget. So we expected this to happen, and we expect those returns on the investments that we would be making to flow through in the future. PPI, our Houston-based business, continues to perform strongly and has really turned the corner. And we continue to work on our portfolio of Latin American businesses, and the progress on that is consistent with our expectations. One thing that we are very happy about is overall our backlog grew by 24%. So we've got a really strong order book, and our focus now is to convert that to very profitable revenue going forward. Now moving on to the next slide, slide 4. Just a bit of a capture of where we see the portfolio. We've got a large portfolio of businesses where we see our businesses from the perspective of positive, improving, and areas where we really need more work to get them to where we want to be. So on the positive side, as I said, we've got a really great business in science and environment, which is very strong momentum, strong margin improvement. We're really happy about that business and how it's going. Our government services business in the Americas, which is primarily serving the Department of Defense, and works around a lot of naval bases, particularly in the Marines and the Navy, also is performing ahead of budget and has a very, very strong backlog. So we're really happy about the uptick in that business as it moves forward. We've got some work to do, which is already well underway, and we're seeing the benefit of that already as we are in the second half on our structures business. So we have a structures engineering business in Houston, and that had a soft first half. We've taken some management action on that business, and that business is already benefiting and accelerating fast towards the end of the year. Utility engineering is a business that we expanded. So this is underground engineering, subsurface engineering. We expanded that business quite aggressively. Some of those expansions didn't lead to levels of new business that we were hoping, and we've trimmed the business accordingly to protect our profitability. And again, that we see an acceleration in results now in the second half as a result of that management action. Construction sciences, second point, is also doing, as I said already, very well. Very good macroeconomic environment, and we really have a good business model there. So that continues to perform well. And as I said, we expected the margins to be down in international development given the investments that we have made in that business, particularly in EMEA. And given that planned reduction in margin, we're actually ahead of budget. We're ahead of where we thought we would be in that business. And generally speaking, the balance sheet, as I said, is in very good shape, and we're very happy to have renewed our bank lending just before Christmas for a 3-year term. In terms of improvements, as I said, PPI is continuing to improve. A big transformation from that business, really changing its business model and focusing on a quality services to oil companies. That transformation is well underway, and we're now in positive territory with a lot of upside potential going forward. So a really difficult transformation that has we're 80% through that with a lot of potential upside going forward. Cash conversion and debtor management has been a real focus. Certainly, Peter and I spent a lot of time with our business leaders on this before Christmas, and we've really cleaned up a lot of our debtors, converted them into cash, and we're very positive about the outlook for the full year in terms of that area. Work in progress. So where I'm spending a lot of my time at the moment is on APAC, as I said. We experienced a reduction in revenue and a reduction in margins because of this runoff of major projects. There are a lot of things that I'm putting in place there, and I won't go into details at this point, but I will talk about them a bit later on. But in essence, what we had in APAC was we had two divisions, North and South. On January the 21st, we consolidated those two divisions into one single division, and that's going to unlock the ability for us to tackle a lot of efficiency issues in that business, both in our back office areas, but in how we go to market, how we collaborate between different offices, how we better serve our clients, and how we invest for growth. So we're already seeing good benefits coming out of that consolidation, and it's really going to give us the ability to get to grips with that business and drive increased revenue and increased margin going forward. Still a work in progress, as it has been for some time, and it continues to be due to the complexity of the issues that we're dealing with, is what's going on in Kamonosca and the wind down of our Ecuadorian projects, which are legacy issues that we continue to work on, but they're very complex, and they just take a long time to work through. So they're progressing as we expected, but you'll probably continue to see us report out on them in a similar fashion going forward for a while. Okay, with that, I'm going to go to the next slide, page 5. And this really is a little bit of what I'm focused on for the remainder of FY19, having come in, taken stock of the business, and really set some priorities for the leadership team. So I've really got two priorities. One is to drive a really good outcome in terms of business performance for the remainder of FY19, given, as I said, that we had a bit of a soft start in the first 3 months. The good news on that is I can see acceleration in all parts of our business towards the end of the year. And then secondly, what I'm really trying to do is to set up a really good FY20. So to put in place the next layer of initiatives that we need to drive the business going forward so that we become really a top-performing professional services business, which is my heritage. So what does that mean in general? Well, from a business structure point of view, when I came in, one of the first things I moved to recognize is that we would benefit from consolidating our APAC North and our APAC South businesses into a single division. And that's exactly what we've done on January 21st. And as I said, that's going to give us a platform to drive more efficiency and better business performance going forward. As part of that review, we had acquired a Shore Search business. And we sort of think about our business. Most of our business is time-based, sort of a white-collar consulting type business. But then we have a very successful business in construction science, which is more a field-based technician business. As we looked at Shore Search, which was in our core APAC division, we actually felt that it rested best in the construction science business. So we've moved that business to align with construction science because there's a much better opportunity for that business to grow because it's a similar kind of business with a field force, with trucks, with field workers. So we think that is a positive alignment for us going forward. Then I'll talk about 3 areas which I think are really essentially important for any professional services business to focus on. And in fact, if you get those three areas right, normally the results come after as a result of that. So the three areas are client excellence, people excellence, and delivery excellence. On client excellence, one of the things I feel very strongly about is moving the business to become more client-centric. So we introduced a key account program in APAC. Similarly, the US are following, and ID will follow in time too. In APAC, for example, we have 23 or 24 key accounts. We have account plans that will be reviewed in February, and we will be going to market, not focused on projects or tenders, but building longer term, more proactive, more intimate relationships with our clients. As part of that, we are increasing our sophistication in how we look at our opportunities. We've rolled out a very good pipeline tool in the US, and we'll be rolling out that tool in APAC as well to give us forward-looking visibility on our opportunities by client and by opportunity. And then the third area is I strongly believe that we really need to measure quantitatively our customer feedback. So we will be rolling out independent client feedback, which will be built into the KPIs of appropriate project managers and leadership teams so that we're really putting teeth to this notion of client centricity. Second area, people excellence. A lot of improved engagement and communication. I've done a lot of town halls. I meet with a lot of our staff where I've asked my leadership team to engage more with our people. We need to be active, visible, and engaging leadership as a leadership team. Introduction of clearer KPIs. We're working on a new set of KPIs for FY20, which will drive our priorities around operational excellence, client excellence, and delivery excellence. And we've just been through a big mapping process called a position classification framework, where we've mapped all the positions in the organization. That has multiple benefits, but one of it is it's the foundations for driving career paths for our people. And there are career paths, technical career paths, and there are management and commercial career paths. We'll be rolling those out in the coming months to our people so that they really understand the opportunities that our business offers them. And then we continue to work on diversity and inclusiveness. We've done some work on gender pay gap. I've just joined the Male Champions of Change for Consult Australia, and that's something I'm very passionate about, opening up opportunities for diverse candidates and establishing a very inclusive workplace. Delivery excellence, the next one. We're working on the end-to-end project management framework of our business to standardize that. So we, again, realized that we had a very decentralized structure and two divisions in APAC. As we look across those, we didn't really have a standard way of doing things. For instance, we had 15 quality management systems at different regions, and we are standardizing all of that, driving efficiency and using technology to drive that. We're rolling out a pricing model where we have calculated our cost rates so that we better understand our cost rates and that we are able to manage our margin, which is obviously very important, particularly in APAC, but in other businesses as well, as we look to increase our margins going forward. And we will roll all of these into new KPIs for our staff in FY20. Improved productivity. So as we look in general at that journey, a lot of the things that I've said have been quite tactical and things that I would expect to see in a professional services business. We have an eye on the future. So last Monday, our Chief Digital Officer started, and she will be supported by our Chief Technology Officer. And those two really experienced and very talented females will be driving our digital transformation. So we're underway on our digital journey, and we're looking at how we digitize work in our back office, work in our middle office as we deliver behind-the-scenes work for our clients, and then driving digital deliverables. Because we live in a digital world, our clients consume digital information. We need to produce more innovative digital solutions for them going forward. And that's going to be a big part of our focus moving forward, moving the business forward. In addition, the other thing that we're doing to drive productivity is starting to understand the opportunities to offshore work in our business. All of our competitors do it. In January, I spent some time in Manila and in Vietnam. We're looking at a number of different offshore suppliers, and we're in the midst of piloting different work packages with them to build a strategy and a roadmap for offshoring. That's really all I wanted to say in terms of my focus. Obviously, there's a lot going on. I'm very excited about the changes that we're bringing. We're beginning to see those benefits coming through. With that, I'll pass to Peter, who's going to take us through more of the detail on our half-year results.
Thanks very much, Ian. So moving through to slide 7, our performance highlights. Ian's covered a lot of these. I'll touch on a couple of them. Firstly, as Ian said, our backlog's up 24%, which is just phenomenal. We're just really pleased with that. It is, though, a combination of the acquisitions being Raba-Kistner and TGM, as well as growth in our international development business, and then growth in the remainder of in the rest of our portfolio of businesses. I've mentioned international development particularly as it runs its backlog projects. A project will typically run for many years. So please take that as directionally very encouraging rather than an absolute indicator of any particular future half's performance. Now, our net profit after tax is $7.7 million. Again, we're quite pleased with. You can see compared to prior periods, this time last year we were briefing the market on the impact of the change in the US corporate tax rates. So that's flown. That's why the comparative looks a little anomalous. We did spend $2.8 million on acquisition costs for the half, being the acquisitions as made. Please take that as symptomatic of the fact that we will not cut corners when we look at potential acquisitions, and we need to ensure that we get our due diligence correct. And as previously advised, we use external law firms and external accounting firms for our legal and accounting due diligence. The cash flow from operations. Now, we're actually, as Ian said, we've made great progress on our debtors, and I think you're going to see that in future halves as it starts to come through. I'll get to that in a couple of slides, but one of the challenges for us is we do have a number of government clients who pay us in large licks, and the timing of those payments can impact us. So, for instance, in the first half of FY18, our cash from operations was actually a little higher than our EBITDA, whereas, in fact, this half, the timing of the payments meant that we had some really healthy receipts in January that are not reflected in the half in question. Moving through to slide 8, this is just a simple waterfall from our operating profit after tax, excluding acquisition costs and the effect of writing off the costs associated with renewing our debt facility a year earlier than the facility had to run. Moving through to slide 9, so this shows our performance for the respective halves, and you can really see when you go down to net operating cash flow the impacts of the substantial receipts received in 1H18 versus 1H19, where timing worked for us in 1H18, which we highlighted at the time, and worked against us in 1H19. In terms of the metrics that Ian and I are most focused on, as well as balance sheet strength and cash flow strength, EBITDA, we're quite encouraged by the result for the half, and Ian will talk to guidance in a few slides. Moving forward on to slide 10, our half-year results. So firstly, just to reiterate, the acquisitions of TGM, the large acquisitions being TGM and Raba-Kistner, they were effective the 1st of December. And when you look at our business combinations note in our financials, you can see the impact they had on revenue and profit for that 1 month, and it was very small. It was not material. December and January in our industry are not the months where we make all our profits, so please don't take that single month as being indicative of future performance. Now, TGM is part of the Asia Pacific business, and as we say here for the half, we managed it in 2 geographic regions, and Ian's going to speak to the structure of that going forward, but that will be a single business unit going forward. TGM is included within Asia Pacific. Construction Sciences, Rabah Kistner, the acquisition in Texas, that moves into the Construction Sciences division. And reflecting on this, we'll need to show Construction Sciences somewhere different geographically on the map, because it now has a really impressive portfolio in Texas and other states around it for expansion in the US in due course. Moving forward then on to slide 11, which is our segments for each of the businesses. Now, Ian spoke to the situation within Asia Pacific and the turnaround we're looking at there. We did have a series of costs associated with right-sizing the business that are reflected in the first half, and I've characterised those as non-repeating insofar as they were primarily associated, as I said, with right-sizing the business and a couple of minor but quite specific project costs which we incurred in the half, which are non-repeating in nature. As we say here, pleasingly, we are bidding on a number of consortia, on quality consortia on a number of bids, yet to really land that massive project, but we're quite encouraged by the strength of the pipeline, and the Asia Pac team are doing a good job working on the relevant bids there. And while nothing's locked and loaded, look forward to talking about that pipeline in future halves. Moving through to the Americas, which is on slide 12, as Ian said, the Americas business they're having a great year. So margins are expanding, and we do see further upside potential. The Americas business comprises effectively 3 divisions: Science and Environment, our Government Services business, which services primarily the US military, and our Infrastructure division. Government Services, this time last year we were talking about some very tough calls that Susan and the leadership team over there were making in Science and Environment, and indeed subsequently in Government Services. And those businesses are really reaping the benefit now of the tough calls that were made a year ago. We have recently taken some tough calls in the Infrastructure division, and with financial performance expected to improve there. That's why we say there is further upside potential in that space. International development, as Ian alluded to, it is a low-margin business. Pleasingly, the backlog looks great. However, it has been subject to, firstly, investments in business development and a number of uncertainties associated with the political situation in the US, the UK, and to a lesser extent Australia. Now, it doesn't really, frankly, impact our results this year, but there is the potential. That uncertainty does drive our outlook for the business. It's solid, but it is a challenging environment for the international development team, who are doing a good job of managing through that. Construction Sciences, on slide 14, the EBITDA margin slightly down on the same half last year. Now, that's a combination of a few things. Firstly, mix of clients. Construction Sciences have some large and great clients that operate on different margin profiles, which, whilst are at the margins, if you pardon the pun, no pun intended at least, they do impact the overall EBITDA margin for the group. Also, there were a number of weather events on the Australian East Coast. Ian and I both hate talking about weather on these calls, but folks in Australia will recall the big wet on the Australian East Coast earlier this financial year. And indeed, while our Construction Sciences folks are getting back up, clearly the weather events in and around Townsville have not assisted the business in the month of February. Now, and as stated, Rabah Kistner is included in the Construction Sciences business. Onto our portfolio companies then. Now, please watch the scale. This is by far our smallest segment, but really pleased with the progress we're making on PPI. Again, 2 years ago, this was a loss-making business. A year ago, it was a loss-making business. And we talked about the strategy of moving into quality assurance, quality control, as well as engineering. And pleasingly, that business is profitable, has been for the last 3 quarters, and we do like on a modest scale, we expect that business to continue to grow. So congratulations to Jim and the team in Houston. On to the half-year balance sheet on slide 16. Now, clearly, with Raba Kistner and Trilab and DDAI and TGM coming in, you do see a larger balance sheet. Also, we did, as Ian had said, has mentioned, we did renew our debt lines in the half. Now, the covenants, which you see in the bottom left-hand corner, are different. So our net debt to EBITDA covenant is 2.5 times, and we're comfortably within that. Our net asset value is $425 million. We're comfortably within that. And fixed charge cover ratio, which is a new ratio, and there's a footnote on the next page that explains that at 2.9. So again, we're comfortably within that. Rolling on to, in terms of the comparative balance sheet strength on slide 17, I just ask that you note that we remain conservatively funded, and some of the key metrics there, like cash and debtors plus WIP divided by debt, it's obviously not where it was a year ago associated with the acquisitions made, but pleasingly, it still remains very conservatively funded. Now, as I said, we did renew our debt facility in December, and it's great to be renewing it with and continuing our long-term relationship with HSBC and Commonwealth Bank, and we're pleased to welcome National Australia Bank into our lending facility as well. On to cash flow on page 18. So I've referenced earlier in terms of working capital movement, the impact of those large government client payments contracts. And as previously mentioned in halves, our income tax paid remains very low. We do have substantial tax assets, primarily in the United States and to a lesser extent Australia. So the cash generated from the business in a rolling 12-month period remains fairly substantial, and you can see that in the FY 2018 result. With that, I'll pass back to Ian to continue the dialogue.
Thanks, Peter. So bringing it home, the last 2 slides. Page 20, focus for the remainder of FY19. We've got our leadership team really focused on improving the business right up until the end of FY19 to maximise our result. And as I said, we've taken management action on parts of the underperforming parts of our business early on, so that we can actually get a bit of an uplift to drive an improved second half result. So that's where we're focused, integrating the recent acquisitions, Raba Kistner and particularly TGM into our Melbourne-based business to create a Victorian business in Australia, and then continuing to build backlog. So big investment in business development. We're in the throes of appointing an Asia-Pacific business development leader and really upping our game in business development. So that's the first one. Second one, operational excellence. So this is really looking at how we just deliver better results commercially and better quality client deliverables more consistently. So overhauling our end-to-end project delivery process, that's well underway. Standardizing, simplifying and digitizing our processes. We're at the beginning of that journey. We will conduct pilots in the first half of the second half of this year, and we will have a continued roadmap throughout FY20 to continue to digitize our business. And we're seeing lots of opportunities in different parts of our business. We just need to elevate those and consolidate and standardize those. Renewed focus on key account planning I've already addressed. So rather shifting the business from being very project-centric to being much more customer-centric, relationship-centric across the longer term, so that we build relationships, we build repeat business, and we're bringing solutions proactively to our key clients. And really importantly, looking at our efficiency and looking at where digital technology can help us with our efficiency, and also where we can't automate or we can't use technology onshore, where we can advantage ourselves by employing offshore labor to increase our efficiency mix so that we become more price competitive going forward. And then the third area is setting the business up for FY20. So a big part of that was restructuring the APAC business, which is done and dusted now. The Chief Digital and Chief Technology Officer to begin that digitization journey and look at our enterprise technology, and then continuing to look at strategic bolt-on acquisitions. And we have a couple in flight already that we might hear more about as they progress. And then on slide 21, a key slide in terms of thinking about so with all of that, what is our outlook for FY19? So we're really working hard, as you've heard, on re-establishing organic growth in the Asia Pacific division, and then focusing on this margin management and dealing with underperforming businesses. We will continue to do sensible acquisitions, and we're very pleased with both the TGM and the Raba Kistner one, and the value that we're going to get out of those, and that we will be continually very careful about our capital investment program as we go forward to make sure that we're really driving business value. With all of that, and with the trajectory that we see in the business and the backlog, we are expecting that in FY19 our EBITDA will come out at around 60 million plus or minus 3 million. So that's the guidance that we're giving today. And with that, I would like to open the lines. Peter, you have one more thing to say?
Okay. Sorry. Thanks, Ian. And look, folks on the call, you'll note that we did put the stock into a pause. I must sincerely apologise. A typo on my personal part. In terms of our guidance, just to reiterate the point Ian made there, our guidance is 60 million plus or minus 3 million. If you haven't already noticed, unfortunately, the media release, I had erroneously put in there a slightly different guidance of 60 to 65. We will be issuing a revised media release that correctly shows FY19 EBITDA guidance of 60 plus or minus 3 million. And again, my apologies.
Thanks, Peter. So we can open the lines now for any questions, which we're happy to take.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you are on a speakerphone, please pick up the handset to ask your question. We will pause briefly to allow questions to enter the queue. Your first question comes from Bob Chen from Deutsche Bank. Please go ahead.
Morning, guys. Just a quick one on the APAC business in terms of some of the efficiencies that you're expecting to sort of extract out of the business. I mean, how should we sort of think about that? Like, where are these sort of costs that you're expecting to extract?
Okay, well, if we take the APAC consolidation as an example, above our locations, our offices in locations in APAC North and APAC South, both of those divisions had their own HR, own recruiting, own finance department. And simply what we're doing is we're saying if we looked at those two overhead structures in APAC and APAC North and APAC South, we can consolidate those structures into one overall structure for the consolidated APAC division. What we're also doing, and the reason why we did the consolidation was not so much cost saving, although that is going to be a byproduct of it, but actually to improve the quality, consistency, and growth of the business going forward under one leadership team. So we are going to deliver a reduction in our overhead run rate going forward, but we have reinvested some of that. So, for instance, for the first time, we will have an APAC business development leader to drive the salesmanship that we need in the APAC business, where we haven't really been focused on proactive business development. We've been more focused on project delivery. So that's a new role going in. Another new role going in is that our former CIO is moving to become the COO of the APAC business. That's a new role. And the purpose of that role is to standardize our project management and to actually manage the offshoring and the digitization of our business. So we think he's a great candidate to do that, being our former CIO, really on the ground, driving those programs that our CDO comes up with across the APAC business. So there will be a net result in a net reduction in run rate, despite those key role investments we're putting back in APAC. It's essentially going to give us a better quality business, one where we hope we can expand our margins and certainly expand our top-line revenue growth.
Okay, great. And then just touching on some of the outlook in terms of M&A, you've mentioned continuing to explore some conservatively funded acquisitions. I mean, which sort of areas are you sort of looking at?
So the first thing I would say is if you look at the business, if you look at our business mix, we've now got, a fairly sizable APAC business and a fairly sizable US business. They're in the same quantum of scale, yet the US market is about 20 times larger than the Australian market. And what's interesting about the US market is it's a state-by-state market. So our strategy is really primarily focused around California, Florida, and Texas, where we have a good footprint. It's really interesting to us to look for sizable acquisitions in the US. So we have a process underway where we are looking to scale our US business significantly. That's one part of it. The second part of it is that we'd like to build density in our APAC business to fill in where we can get strategic benefits. So a great example of that would be TGM. We're already well established in Melbourne, but we're not well established in regional Victoria. That gave us the TGM business with Geelong and Ballarat and Hawthorn gave us a great fit to our Melbourne business to increase our density in Victoria. There are other markets in APAC where we're looking for similar kinds of acquisitions where we can increase our density.
Great. Thanks, guys.
Thank you. Once again, if you wish to ask a question, please press star one on your telephone and wait for your name to be announced. We'll pause again to allow more questions to enter the queue. Your next question comes from Denison Hambling from First Samuel. Please go ahead.
Yeah, hi guys. I'm just trying to work back from the guidance. So at on the acquisition of Webcast announcement, you talked about approximately 3.8 million of EBITDA to the 19 results. I guess if I look at the guidance and you take that off, I mean, the business isn't really going anywhere. And it just seems to be disconnected a little bit to the tone to which you're delivering. I mean, can you just talk through that a little bit?
Yeah, so I think you're right in terms of the base business. Well, you're right in the fact that it's a flat result. So for the base business, it's a flat result at a net level. But what I can tell you is that there's a lot of dynamic under that flat result for the first half or for the year, which is that we've got some businesses that are really performing well and powering forward, and some other businesses that had a really soft start to the first 3 months of the year, which we are now attacking and improving. So the reason for the, if you like, to use your phrase, more of an upbeat tone on this is that I know where the problems are. I know where the challenges are, that we've actually attacked a lot of those. We've got a really good backlog. And in some of our key core businesses, we are growing and we're expanding margin. So the transparency of our business in terms of where we're going well and where we've got work to do is very good now. The action that we've taken, we're really confident will accelerate us into FY20, and we're investing, as you've heard. So we're putting some pretty key roles into the business, which will really set us up for the future. So I'm really happy about it. You could say, well, why are you happy about a flat result on last year? Well, we really had, in APAC, we had a tough time in the first 3 months, and now, if I look at that first half as a game of 2 halves, the first 3 months versus the second 3 months, the second 3 months were much better. So I'm actually very optimistic about how we're going to move this business forward. And my view is, I'm in month 4 or month 5. I'm in this for the longer term. I'm in this for 4 or 5 years. I'm building this business to build shareholder value over that period, and I'm very confident that we can get there.
Look, that's great. I mean, I think the question probably that people will be trying to struggle with is, it comes back to like, what is the longer term margin in this business? I mean, I've been invested in this business for 10 years, and I've seen it deliver between 13.3% EBITDA margin and 3.5%. And I think the challenge, given we're now 2 or 3 years into a new process, and I recognise you're fairly new, Ian, is trying to actually get a sense as to where's the reasonable expectation that, on a fairly consistent basis, this business can make money. Because revenue, it feels like revenue's going up again. But it's hard to know when you sit outside where sort of margin's going to be in 2 or 3 years' time if things go okay.
Yes, so Dennis, Peter here, let me take a swing at this. Thanks, Ian. Historically, over the last few years, we've talked about EBITDA margins, best practice in Asia Pac being in the double digits, the low teens, and best practice in the US being in the mid to high single digits, to give an overall combination of somewhere there or thereabouts. Just to be clear, as Ian said, our base business is flat year on year. So, and as we've clearly said, our first half is down year on year, and we are expecting a strong second half. So, if that's us being ebullient, then that's we're very realistic about the quite significant amount of work that needs to be done in this second half. Just to be quite clear about that.
Oh no, it's not about the second.
Yeah, sorry, just to finish my thought. We aspire to those margins. We've been saying for a couple of years now, that's what we aspire to. Clearly, the Asia Pacific business is not where we'd like it to be, and Ian spoke to that and explained what we're doing about it. In terms of the US business, we've got 2 of our 3 divisions that are performing well, and we have made the leadership team has made some tough calls on that, and we do think we can do better in the US business. So it's, as Ian said, this is a long-term game. We would like to see ourselves approaching approaching best practice for those 2 businesses. So that may or may not directly answer your question. Sorry, I interrupted you.
No, that's okay. I mean, it's just a hard thing to observe, to understand. It's just hard. I mean, you've got the settings of the business. You've got to invest in the business. No problem with that. As I say, I think it's just hard for people to sit back and say, okay, well, where does this actually get us? And then, because being a number of years in, it actually doesn't feel like there's going to be a big margin path at the end of this. We might be a bigger business, we'll generate good returns, I've got no doubt, not questioning the decisions. It's just, when you actually sit down with a model and say, what's the better business, more reliable, better staffed, all those good things, but it still feels like a relatively low margin business. And part of that, I mean, the cost base half on half is $24 million higher, and I know you've got to invest, but it's pedaling fast, essentially, to stand still, is what it feels like. So anyway, look, I think something food for thought for you is that margin. I mean,
It's a good challenge. Just a couple of points on that. I totally understand where you're coming from. I spent 30 years in professional services, so I think, in different industries, but, we definitely aspire to be in double digits. It's somewhere between 10 and 15%. If the upper end of that would be fantastic. Where do I see us getting there? Well, interestingly, the two businesses that we bought had higher margins than we had. You might expect that because they're not, they haven't got all those corporate overheads that we have. But we're very conscious about putting investment into higher value sectors and higher value businesses. That's point number one. Second point, which gives me a lot of interest, is that if I look at offshoring, for example, we do approximately zero in offshoring. And I look around our competitors and they're doing, somewhere between 10, 20% of their work offshore. So for me, that's an opportunity. Secondly, on digital, we've got very little digital enablement of the work that we do. And I look around at some of our competitors and no one's really got that right. But I think there's opportunities where some competitors are doing it better than us. And I see real upside there. So I'm very conscious about driving margin in our business. And I'm really focused on that. And I can see some pathways through to getting that more consistently.
Great. Thank you very much.
Thank you. Once again, if you wish to ask a question, please press star one on your telephone and wait for your name to be announced. Your next question comes from Roger Leaning from Morgans. Please go ahead.
Good morning, guys. I'm just interested in the 20 million capex and just a bit of colour around that. You allude to possibly some underinvestment in the past. I'm just wondering how much is catch-up and how much is going to be allocated towards some of these new initiatives such as productivity and delivery excellence.
Yeah. So Roger, Peter, as we've said in the past, as we said 6 months ago, we have underinvested in a number of things, including technology. So the vast, however, at the same time, our business is bigger than it has been in the past. So a number of these, frankly, are finance leases. The vast bulk of our capex falls into two things. It's a high ace or an F-250 towing a piece of kit that may or may not do underground radar, as an example, and then it's primarily a bit of technology, with a distant third being facilities, just leasehold improvements. So a small amount is technology of that, but it's at the margins. Now, I do anticipate that, as Ian said, our Chief Digital Officer, Nicola Dorling, has only just joined us. And so as Nicola is working with Ian and the leadership team in terms of the digital strategy, I do anticipate modest investment there, but I stress the word modest.
Yeah, and just to concur on that, Peter, I think job one in the digital and the enterprise technology arena is to work the technology that we already have. And what I mean by that is quite simply that, we have things up and running like SharePoint, and I think we're using about 5% of its capacity right now. So we just want to get more value out of our technology that we have. We want to embed that in our work processes, and then we will move forward looking at other things. The good news about some of the digital work enabling technologies is they're actually quite cheap. It's not like doing a SAP installation 10 years ago where you had to spend $50 million in 3 years. So you get actually really good ROIs from some of the new digital technology. So again, we're going to do things where we have a business case that makes sense and is good for the business, good for our clients, good for our people.
Thanks.
Thank you. There are no further questions at this time. I'll now hand back to Mr. Ball for closing remarks.
Great. Well, thank you very much, everyone. Thank you in particular for the folks that asked some questions. They were really good questions. We've got some good guidance from you. We hear what you're saying. We're absolutely focused on driving shareholder value up, increasing the margins, increasing the growth, and being very commercially astute in this business as we move it forward. Thank you for attending the call, and look forward to speaking to you and seeing you around and closing out the full year later on this year and talking about our results then. Thank you very much.